SA 250. Consideration of laws and regulations in an audit of financial statements. Scope of this essay. The standard on auditing deals with the auditor's responsibility to consider laws and regulations when performing an audit of financial statements. Objectives of this essay: to obtain sufficient appropriate audit evidence regarding compliance with the provisions of those laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statements, to perform specified audit procedures to help identify instances of non-compliance with other laws and regulations that may have a material effect on the financial statements, and to respond appropriately to non-compliance or suspected non-compliance with law and regulations identified during the audit. Definition. What is non-compliance? Acts of omission or commission by the entity. Omission or commission by the entity, either intentional or unintentional. Omission, commission, intentional, unintentional, which are contrary to the prevailing laws or regulation. Such acts include transactions entered into by or in the name of the entity or on its behalf by TCWG, management or employees. Now, non-compliance does not include personal misconduct unrelated to the business activities of the entity by TCWG, management or employees of the entity. Responsibility of management. It is the responsibility of management with the oversight of TCWG to ensure that entities' operations are conducted in accordance with the provisions of laws and regulations. Responsibility of the auditor. What are the responsibilities? The requirements of this essay are designed to assist the auditor in identifying material misstatements of the financial statements due to non-compliance with law or regulation. However, the auditor is not responsible for preventing non-compliance and cannot be expected to detect non-compliance with all laws and regulations because of inherent limitation of the audit. The auditor is responsible for obtaining reasonable assurance that financial statements taken as a whole are free from material misstatement, whether caused by fraud or error. The auditor is responsible for obtaining reasonable assurance that the financial statement taken as a whole are free from material misstatement, whether caused by fraud or error, in conducting an audit of financial statements. The auditor takes into account the applicable legal and regulatory requirements. Owing to the inherent limitations of an audit, there is an unavoidable risk that some material misstatements in the financial statements may not be detected even though the audit is properly planned and performed in accordance with essays. This essay distinguishes the auditor's responsibilities in relation to the compliance with two different categories of law and regulation as follows. Two different categories. The provision of those law and regulation that having direct effect on the documentation, on the determination of material amounts and disclosures in the financial statements, such as tax and labor laws, and other laws and regulations that do not have a direct effect on the determination of the amounts and disclosures in the financial statements, but compliance with which may be fundamental to the operating aspects of the business, to an entity's ability to continue its business or to avoid material penalties. Note, in these essay, differing requirements are specified for each and above categories of law and regulation. For the provisions of those laws and regulations having direct effect, the auditor's responsibility is to obtain sufficient and appropriate audit evidence about compliance with the provisions of those law and regulations. And for other laws and regulations that do not have direct effect, the auditor's responsibility is limited to the undertaking specified audit procedures to help identify non-compliance with those law and regulations that may have a material effect on the financial statements. Now, audit procedures. Understanding the legal and regulatory requirements. Obtain sufficient and appropriate audit evidence regarding compliance with provisions. Perform specific audit procedures to identify instances of non-compliance. Professional skepticism. should remain alert to the possibility that other audit procedures may help in identifying non-compliance or suspected non-compliance. Request management and TCWG to provide written representation. Audit procedures when non-compliance is identified or suspected. Non-compliance identified and suspect identified or suspected. If the auditor becomes aware of information concerning an instance of non-compliance or suspected non-compliance with law and regulations, the auditor shall obtain an understanding of the nature of the act and the circumstances in which it has occurred, and further information to evaluate the possible effect on the financial statements. If the auditor suspects that there may be non-compliance, the auditor shall discuss the matter with management and TCWG. If management or TCWG do not provide sufficient information that supports that the entity is in compliance with law or regulation, and in auditor's judgment, the effect of the suspected non-compliance may be material to the financial statement, the auditor shall consider the need to obtain legal advice. If sufficient information about suspected non-compliance cannot be obtained, the auditor shall evaluate the effect of the lack of sufficient appropriate audit evidence on the auditor's opinion. Reporting non-compliance in the auditor's report on the financial statements. If the auditor concludes that the non-compliance has a material effect on the financial statement and has not been adequately reflected in the financial statements, the auditor shall, in accordance with SA 705, express a qualified or adverse opinion on the financial statements. If the auditor is precluded by management or TCWG from obtaining sufficient appropriate audit evidence to evaluate whether non-compliance that may be material to the financial statement has or is likely to have occurred, the auditor shall express a qualified opinion or disclaim an opinion on the financial statement on the basis of a limitation on the scope of the audit in accordance with SA 705. Now, matters which are indicating to the auditors about non-compliance of law and regulation by management, that is, they are indicators. Investigation by regulatory organization and government departments, or payments or fines of penalties, payment for unspecified services or loans to consultants, related parties, employees or government employees, sales commission or agents fees that appear excessive in relation to those ordinarily paid by the entity or in its industry or to the services received, purchasing at a price significantly above or below market price, unusual payments in cash, purchase in the form of cashier's checks payable to bearer or transfers no numbered bank accounts, unusual payments towards legal and retainership fees, unusual transactions with companies registered in tax havens, payments for goods or services made other than to the country from which the goods or services originate, payments without proper exchange control documentation, existence of an information system which fails, whether by design or by accident, to provide an adequate audit trail or sufficient evidence, unauthorized transactions or improperly recorded transactions, adverse media comment. This is all about SA 240.